So the interest rate is 6.3. Thank you for that. What else do we know? What's the second one?
The cost of equity?
Okay, so that cost of equity is what? CAPM?
Yeah.
What'd you guys get?
I had 7.3%.
7.3? Or was that whack? What'd you get?
Wrong.
It doesn't have to be wrong.
I could definitely be wrong on this one.
It's risk-free, right? Plus beta times return on the market minus risk-free. What's risk-free?
4.7.
30-year treasury bond, right? For the current year. 4.7? What's beta?
1.2.
What's return on the market? I didn't give you one, did I?
I just used 5%.
You can make this be 5 if you want. What did the paper say? 5 to 8% or 5 to 7% or something for risk premium. So if you want this to be 5%, then your answer here would have been 9.7 to make it 5, right? Okay, so it'd be the 5. Or if you wanted it to be something like 8%, you'd have 8 added to the 4.7. This would be 12.7. So somewhere in between those, I guess.
So where
Right?
does guess?
Of course you do. Nobody knows what the return is going to be on the market forever. You have to make one up unless I give you one, right? Now here, beware. I can either tell you this number or I can tell you this number. If I tell you the return on the market is 11% or 12% or 13%, that's the return on the market. You subtract the risk-free from it then to get the risk premium, wouldn't you? This is the risk premium down here. You guys have got to get this stuff internalized. You got to know what you're doing here. Okay? It looks like, oh, gee, it's just one problem. This is going to be easy. This thing will explode on you. Okay? So work at this. Work at this. All right? And the quizzes are going to be horrible. And then we'll fix it before the test, okay?
Yeah.
If you work your ass off, the quizzes will probably still be horrible. And you're going to have the formula sitting right in front of you and not know what to do. Okay? That's how this works. It just does every semester. Okay? But then by the time you do the final, what do you do? Okay? For those of you who get it on the quiz, by the time you do the final, say, that's 25 free points, thanks, Keith. Right? So how many points on this thing? 25 for a quiz, doing one company. Right? On the test? I don't know, another 25 probably. 20, 25. How many chapters are on the test? I don't know, whatever. 4, 25 probably. And then how many on the final? Maybe another 25. 75 points out of 650. Do I want you to know how to do this? Yeah. If you know how to do this, you can do present value, cash flows, you can do lots of stuff. Okay, you can read financial statements a little. Okay, anyway, so what number do we get then? Let's do it.
So which one are we using?
Which one do you want to use?
5 or like the 9.7.
She wants to use the 9.7. You got it. So 5 times 1.2 would be 6 plus 4.7, 10.7. Is that what it is? That would be a good answer. What kind of answers did you guys get? If you use the 5%, right? 5 risk premium added to the 4.7 risk free gives me a return on the market of 9.7. That's what you use, so we'll do it. Get your spoke first, you get your way. That happens a lot in business, too. Have the first idea, you're running the place. Sometimes. Okay? Okay? Whatever you think it is. So if you think it's going to be 12 forever, like I do, you use 12 less 4.7. Right? And what would be your risk premium? 12 less 4.7 would be what? 7.3, which I think is about the normal risk premium. Yeah. And normal risk frees are 4 to 5. Probably maybe 6. Okay? Over time. All right, what's the next thing it asks for?
It asks for the weight of debt.
Now this has to be, and then it wanted weight of equity too, did it? Okay. What did you guys get?
I got 16.67%.
For debt?
16, sorry.
Oh, 16. That sounds better. This should be based on market value, right?
Yeah.
So 16.7% maybe, which makes this one be 83.3. Is that right, guys? That's true. Okay, does that sound right? Did you get those? What's that going to be? You guys aren't saying anything. Everybody has that number? You got those numbers? Look. Did you guys know this? All we're doing is the weights. Okay? What are we using as a proxy for market value for debt? Book value.
Yeah.
Right, it's easy, isn't it? What's the ending book value? We're gonna use ending, not average here, of course, because we're valuing the company at the end of the year, right? So how much was that, 100?
Yes.
Okay, good. What's equity? The market value per share? What was that?
$10.
$10. How many, and times the outstanding shares? How much?
50 million.
And how much is that, 500 million?
Yes.
Okay. Add them together, and what do you get? 600 million. Seems to me like this is 1/6, which is 16.7%, and this is 5/6. And this is 6/6, 100%. You guys can't do this, you didn't do it yet. You see what you use, book values?
Yeah.
Knock it off. It says in the paper that we're doing market value. I said in class we're doing market value. You guys are working too much in other classes instead of mine. Stop it. It's your career. Okay? Accounting or finance major, either one. Nobody in here is not one of those. This is your career. You gotta know how to do this. Okay? Inside and out. Intuitive. I want a lot of hours over the break. Not the Mickey Mouse stuff my principal's kids will do. When I suggested 60 hours, they'll give me 5. I'm lucky. You guys need to give me 30 for this class. Plan it. Get on your schedule. And do it. Not just this. Learn those present values, future values. You don't know how to do it. Figure out what's going on in chapter 4 and 5. I just did the test. It's hilarious. I am giving you a problem where the financial statement is all screwed up and you're going to tell me everything that's wrong with it, and there are 18 things wrong with it for 18 points. Are you ready? No. You know, you guys don't know chapter 4, you don't know chapter 5, you don't know chapter 6, and you don't know how to do this. Am I right? And how well am I going to expect you to know it? Inside and out. Totally unfair. And then later, I want you to send me, my 10% of your $500,000 a year you make because you work your ass off. Okay? You'll never see it, Will. Nobody's ever sent me a check yet. Some people have bought me dinner before, though. That's kind of cool. Bought me good bourbon. Steve Cake buys me bourbon every once in a while. I don't know if he's making that much. He might be. It's well over 200,000. Well, yeah. He likes to work too much, though. So I don't like to work like that. That's my excuse. I don't want to work. Okay, what else? What's the next thing to ask?
Whack.
Okay, this is going to be the weight of the debt times the cost of the debt. Oh, by the way, what's the after-tax cost of the debt? What's the tax rate?
Oh,
So let's get KD over here.
for tax rate, do you want us to do the average or just the...
What's normal? What are the different tax rates you got for the 2 different years? They give you 2 years, right?
Yeah,
Are they different or are they the same?
they're very different.
So what do you think is normal? That's what you need. That's the judgment you're going to make. You can maybe do the average if you think that's normal. Kind of hard to tell with that. There's no tax footnote to read like we would with the real financial statement, right? I'm going to give you a real company for the quiz. And you're going to go somewhere and find a computer or bring your computer with you, and you're going to look up their real financial statements and do this. Okay? So different.
So for the first, or the last year, it was 37.5%.
37.5. That's fine. What was the other year? Close to the same, isn't it? I don't know. It's a long time since we wrote that.
It was 25%.
No, 25. What do you think is more normal? 37, 34, 35, 36. Somewhere between 35 and 40 for most companies. Not always, right? Not always. They have a lot of international business. They don't pay very much taxes internationally, right? I've heard about companies going offshore to avoid paying taxes. Okay, anyway. So what would it be to get KD? We'd take that 6.3 times what? 1 minus the tax rate. So if we use 37 and a half, 1 minus 0.375, then you'd take 0.625 times 6.3, and what do you get, guys? That's this one.
3.93.
Yeah, somewhere in there. That would be a good guess, okay? Right? By the way, I will put all of your answers into a spreadsheet I have and see if I can give you points. Right?
So if,
All the errors you make, I'll try to just take off for that error, and then I'll put it in the spreadsheet and roll forward, so that you don't lose points because of domino errors, right? Continue.
so if I did like the average tax rate, you wouldn't take off for that? Or?
Probably not, unless it looked ridiculous. And I'd say, really? Do you believe that? No. Why would the average make any sense? What do you predict for the future? So you could go read the tax note and see what you think would happen. If they have a one-time thing happen, it causes the rate to be way lower or way higher. You're going to use that one-time thing, or you're going to use normal. Try to figure out what normal is for that company. So this is an art, not a science. Okay, it's a great question. Okay, so what would you do, guys? Wouldn't you take 16.7% times the 3.93?
Yes.
This one times that? And wouldn't you take the 10.7 times 83.3 and then add the two together? What do you get it to do that? What kind of a number did you guys get? You didn't do very well on this, did you?
For the debt, it's 0.6575.
Okay, so the debt, weight times the debt is 0.6.
575.
Okay, that's percent. Okay, right? It's 3.93 times 16%. Okay, and then what's the other one? Around 8%? 1/6 of this is the number. Is that 0.65? That looks about right. 1/6 of 4, right? About 0.6. What's 10.7 times 0.833?
8.88.
So what do we have? 8.88, say. Add those two together, right? What do you get? 0.66 plus 8.88.
9.54.
That'd be our whack. Okay. What else did it want?
Digital cash flows.
Okay, what are you going to do for estimated cash flows, guys? What'd you get?
I have 50,000.
You got 50,000? No, or 50 million, I guess.
Yeah.
It's really, yeah. The 50? Does that sound right? You guys got that? What'd you do? You took the operating income. How much was that? You guys are looking at me like you didn't do this. That's making me real uncomfortable. We had a couple days. Still haven't done the first stuff. Good. Okay, what was the operating income?
Is that before or after?
Pre-tax, yeah. Pre-tax.
Oh, okay.
24.
24.
24 before tax? Excellent. Okay, that sounds right. 24 million, I think. Okay, and then we're going to take that times 1 minus the tax rate, and you use the same tax rate, right? Which, if you use the 37.5, you're going to get the net income here, aren't you? Right? Because what's 1 minus the tax rate? 1 minus 0.375. What does that give me?
15.
15. Because the tax is exactly 9, isn't it? Okay? So that's the way I would have done it, probably. Okay, but if you use the average, it's okay. It's rational, right? That's why we do it this way. We get normal continuing operations income, right? Normal continuing income, right? Talked about that last time. And then we get to keep, right? 1 minus the tax rate of it. Okay, so that's the 15. And then what are we going to add to this?
The depreciation.
Yeah, depreciation, amortization. How much is that? And then we add the two together, and what do we get? It's a miracle. 50. Okay? It's not a big deal. This one was supposed to be really easy. Okay, then what's the next thing of this?
The estimate total market value of the assets.
Okay, so how would we do that?
Just add the equity and then add market value.
No. That's what you did to get the weights. We're doing our own independent estimate now.
Oh.
What do? We take our estimate of the cash flows. How much was that? We just did it. It's 50 million.
Yeah.
And we divide that by our estimate of what? Whack. That's how much they're supposed to be earning on the assets. What did we say that was? We decided it was 9.54. People ask me how many decimal places you go to. Nah, I don't care. Right? You know, a couple is good, probably. I wouldn't go more than that. Okay? 1's probably enough. 9.5 is probably good enough. We're just estimating anyway. These are really rough estimates. If this is what you're supposed to earn on the assets, and that's how much you are earning on the assets, how much must the assets be worth? That's all we're doing. Estimated market value of the assets is what?
524,109,014.
524 point what?
109,14.
Oh, so one. Good enough? Million? Good?
Yeah.
524.1 million? That's probably close. Okay? Subtract estimated market value of the liabilities. Now here we'll use exactly the same one that we did when we did the weights, right? So how much was that? Because we're assuming the market thinks it's about book value too. If we don't believe that, we can use the market value of the debt. What if they're bonds? Use the market value if you want, right? You can do this any way you want. It's an art, not a science. So what is that, 100?
Yes.
What do we got now? You know, these assets less the liabilities. Oh, by the way, that was the answer, right? The assets less. Yeah. Good. And then what do we have? 424.1. Did I ask for that? Market value of the equity? Sometimes I do.
The estimated market value per share.
Well, then what do we have to do? If that's the total estimate of the market value of the equity. How about dividing it by the shares? We already knew the outstanding shares, right?
Yes.
How much?
50.
That's million shares. What's 15 to 424.1?
8.48.
Okay, the stock should be selling for 848 if there is no growth. This is no growth here. Cash flows are not changing. We're assuming they're going to be 50 forever, right? So picture where the company's at right now. Here's how much they should be earning, and here's how much they are, right? Cash flows. Forever, we think. So the stock should be selling for 848. What's it selling for? 10. The market must think what? Make this ridiculous assumption. Make the assumption they agree with everything we did in all those calculations, right? The only thing that they know that we don't know, right, that's different than us, is they have an estimate of what? Growth. That's it. How much growth? So what we could do is we could take the 50 and try growing it at different rates to infinity. No, I don't want to do that math problem, do you? It's impossible, right? You can't get there. But you have to go to infinity. But here's what you can do. Get this intuitively. If you need to earn 9.54%, but you get some of that out of growth, you can take the growth away from that because you're getting it out of growth. So let's say I have 3% growth. That's really fast, right? But let's say I have 3% growth forever, right? Forever. By the way, you only have to worry about the first 20 or 30 years, right? Yeah. Because the discounted present value of the cash flows at 9.5% are nothing after that many years, really. So you're guessing for a period of time. And there are all kinds of models where you can guess different growth rates for different periods of time. You know, do 5 years at one rate, the next 5 at another, and then after that do some other rate. So we can do anything mathematically here we want. But this is just real quick. This is a simple version. Okay, believe me, it's very simple. So what do we do then, guys? We will say, well, let's take the growth away from WACC. So it's just like this. It's exactly the same formula, but changed a tiny bit. Estimated, this is with growth, okay? Estimated cash flows, which are 50, divided by WACC, minus growth. Okay? Minus the growth rate percentage. That will give me my estimate with growth. That's all.
Wait, don't you? I thought you had to.
There's one more piece. What do I have to do?
For the cash flows, add on the growth.
Yeah, I want to take this times 1 plus the growth rate. And why do I want to do that? Because I want the end of the first year, right? It's a year out. So I need growth on the first one. That's all. Okay? Okay, so what do we do? Let's calculate. And then we're going to, after that, we'll subtract the estimated market value of liabilities, which will be the same. Okay? Equals estimated market value of the equity. So what kind of growth rate did I suggest to you to try? Divided by outstanding shares.
Assume 3% future growth.
Okay, so let's assume 3%. Okay, so we'll get this number. So what do we have? Estimated cash flows are 50. Take it times what? 1.03. By the way, can growth be negative? Yes, you just subtract the growth rate, right? If it was a -3, it'd be 0.97. Got it? That's pretty simple, isn't it? Okay? What's WACC?
10954.
What was growth?
3.
Yeah. 3.0%. Right, guys? So take 50 times 1.03. What is that in?
51.5.
Yeah, it's 51.5 million. Absolutely, that's what that is. What's this here? 6.54%.
Yeah.
Divide 6.54% into 51.5 and you will get the estimate of market value at a 3% growth rate. That's it. Okay? Whatever the growth rate is. So you take out your crystal ball and you say, how much do you think the cash flows are going to change by? Right? Okay. High growth company, low growth company, negative growth company, whatever. Okay? So what do you do now? 51.5 divided by 0.0654, what do you get?
Uh, 787.5 billion.
Okay. Less the 100 million of liabilities gives me 687.5 million market value of the stock at a 3% growth rate, divided by 50 million shares. And what do we get, guys?
13.75.
I bet you the market doesn't think it's going to grow that fast. What do you think? Because the market value is 10, huh? So how would you back into what the market must think? That was the last piece, wasn't it? Or second last piece, I guess. This problem. Okay? What do we do? I say I did because I wrote this a long time ago, long before we did the paper. Okay? What do we do?
Wouldn't it be how much the market think it is minus what you think it is?
You could calculate it that way, actually. Yeah. But I think what we could do is estimated cash flows, and let's leave out the 1 plus the growth, just get fairly close. Let's divide it by WACC minus growth. Okay, but let's go the other direction. What does the market think the stock's worth? $10 per share, right, guys? Per share. Then let's take that times 50 million shares. We've already done this anyway, haven't we? We already did it to get our weights, so we know what this stuff is. So if you had 50 million shares at $10 a share, wouldn't you have that equity of 500 million? That's what the market thinks it's worth, right, guys?
Yes.
Then wouldn't you add your liabilities of 100 and you get back to the 600? I didn't have to write all that down, did I? Because I already knew the 600, didn't I? So there is some growth rate that's going to make this work. Assume the market thinks that you're going to earn 50 million, right? And they think the stock is worth 600 million. What must be WACC minus growth? Take 50 and divide it by 600. What's that?
8.3.
It's 8.3. Got it? What's WACC? 9.54%. What must growth be? Solve for G. 9.54 less 8.3. 1.24% is what the market thinks growth is, right? That's it. You're going to get really good at this. But you got to start working at it, am I right? Is that a true statement? You did this in finance already? It's the same exact thing, isn't it? Yeah, so you already know how to do it. That's kind of. How many of you have not done the finance class yet? Are you sitting in finance with people who have done this in intermediate?
Yeah.
Yeah, they're annoying, aren't they? Because they already know how to.
Yeah.
So either way, doesn't make any difference when you learn it. It's a nice review though here, isn't it? It's going to be real solid for that class. Okay, Dan Bauer thought, geez, he's accounting majors.
That's who my teacher is for science.
Dan Bauer, yeah, so he knows. Oh yeah, he did mention you. He said you were pretty bright. He says, I haven't seen the evidence for that. Yeah. He said that you must be a accounting major. He said you must be good. And if you're a finance and accounting major, both, yeah, then good. There was one other thing I asked for, and I think it's really fun. It's not really whack cap in, but what did I ask you to do?
What were the dividends?
What were the dividends? Okay, I don't have retained earnings, but I gave you equity, and I told you there was no contributed capital during the period. So did you do this? Did you get the 15 net income? 15 net income got added. Contributed capital is nothing. What was beginning equity?
100,000.
What's ending equity? Ending the dividend was? How many got it? That's hilarious. It always like that. How come when you start doing something that is a little different, right? This whack cap in thing, you forget basic principles of accounting. Why did that happen to you? I don't know. Don't forget what you already know, you guys. That's silly. Don't do that to yourself. That's fun. That's all it's fun. Executive MBA simple. Nothing. No. So, including the accounting majors that are in the MBA, right? You know, that CPA would not be able to do it. But, okay. I just laugh. That one's just there. Crazy. They get angry about it. That makes it even more fun for me. So you want to take a look at a real company?
Yeah, sure.
Let's pull up. Which one did you do? Which one did you try to do? Target. Okay, good. Right. Did you get some of those answers?
For Target?
No, for the handout question.
I forgot to spell here.
Oh, you didn't do it.
Target.
Oh, all right. That's fine. That's okay. Well, then you can value Target for yourself. Good.
Wrong company.
So let's see. What did you type in to go find it, by the way? Oh, I don't want to be belling into it. How do you get on this thing to, you want to just type in Target? That's one way to go. Do not use the financial statements that are in Yahoo Finance because some minimum wage kid, must be a third grader. No, I don't know. Somebody is taking numbers off of the real financial statements and combining them in all sorts of strange ways and plugging it into their thing, you know, because they have a particular format. Use real statements to crank out loud so you can read them. You might get the same numbers, or you might not. Way too often you don't. So don't use that stuff. There are real financial statements. So what we're going to do is we're going to go to Target. Okay? What do you want to do? Find Target Corp? Here they are. Look at that. Target.com. That'd be good. There's a stock price even today. Look at that. They want you to know. They'd like you to buy. Okay. So how do you find their financial statements? Where'd you go?
Bottom page.
Down at the bottom of the page, they have something called investor relations usually. Look at that. Isn't that clever? So you look around until you find investor relations. I know you guys know how to surf the web. You are not buying clothes out here. Yeah, okay, that's funny. All right. Anyway, whatever Target sells.
2014 annual report.
Okay, do you have one? There's a 2014 annual report. That would be nice. Use the most recent annual. Oh, use the annual. What would we do in real life? We'd use the most recent quarter, right? And then we'd make it a full year by looking at a variety of quarters and putting them all together. You know what I mean? And then add one, subtract them, what do you have to do to make it a full year? So we can adjust for that. But anyway, so we get closer to the current date. But let's just use the annual report for our purposes, okay? And by the way, you want to write down that 78.27? That'd be okay, right? That's the market price. They keep it updated all the time to fetch anything. So welcome to their annual report, and you can go all the way through their annual report here. Okay, there's a letter from the president of the company and stuff. But if we want the financials, we could go right here, or we could go to the 10K report, right? With a company like Target, I'm fine with going to the financials here instead of the 10K. If they give us if it's really easy to search, is that what you did? Or did you go to the 10K? 10K is a real report. This is highlights. I don't want that. I guess I'm going to the 10K report because they don't want to give me. Let's do the 10K. Financial highlight, financial summary. Yeah, I don't want that. I want the real report. Don't you guys? All right, there it is. Fast today. That's good. This is the one filed with the USC. The United States SEC. Yeah, USC. Anyway. So we'll go find the financials here. Where are you going to find the financials? It's going to be in one of these, isn't it? Is there a table of contents here?
You know, in part 4.
Can you do a search? Yes, towards the end. Okay. This is as friendly as it used to be. financial statements, look at that. Okay, there we go. So you can look around, you can find them, okay? And here we go. It's telling you what all the exhibits are, I guess. Item 5, financial statement schedules. Where they're financial statement, anywhere.
I really doing a good job of hiding.
What up? Jim?
Really live. Not very nicely. Management discussion and analysis. Financial statements, there they are. There's the management's report. There's the independent registered public accounting firm, us report. The internal control from us. Let's see, consolidated statement of operations. Here we go, we're into it, huh? And then there's one of comprehensive income, then there's statement of financial statement, there's the balance sheet. So what do we need? We're going to go to the statement of operations. You guys write these numbers down because we're going to use them. Okay, what do you want to use off of this statement? There's a real one. What did you pick up?
Operating income.
You want the income. I wouldn't use operating income without looking at it first, though. Would you? Sales. Does sale look normal? Yeah. Do cost of sales look normal? Yeah. Selling in general, they always have it. Right. Credit card expenses. What they did was they sold off. You go read their notes. They sold off their credit card operation to a bank. So that's not there anymore. Would you include it? Of course not. Right. They don't do it anymore. Okay. Would you do the credit card revenues? No. Same reason. Right. So they sold that off. Made a big profit on it. Okay. And got out from under that. Depreciation and amortization, you can pick it up here. Go ahead and write it down. So write down the depreciation and amortization, and then we'll make sure on cash flow statements the same number. Right? I do that. Everybody write it down. You can't value it without it. How about the gain on the sale, the receivables transaction? No, I just told you that's over with. So we're going to pick that up. Okay? How about interest expense? I picked that up. See, there's income from operations is 4535, but then they have 882 net interest expense down in non-operating. I think interest expense is something they always have. I'm going to pick that up. In fact, I'm going to use that interest expense to do what? Calculate their interest rate, right? You can also look up their bond rating to find out what the interest rate is. That's what you do in finance. Huh?
So
That's really good if you're going to do a new project. Not any good if you're valuing a company that already exists, in my opinion. You got to use what their real interest is, not what they'd have to pay if they borrowed. That makes sense? So you tell Dan that. Dan will say, yeah, you're in Keith's class, fine, he's right. And you know what? I'll say the same thing. He's right too. Both right. This is an art, not a science. But you get different numbers. Okay, so write that down. Write down the 882 interest. Okay, and then provision for income tax. What do you want to do with that? I want to find out what percent that is of earnings before income tax. Don't you guys? So I'll calculate all three of those probably, and I'll also look at the notes to the financial statements. There's a tax note. Did you do that? And they calculate it for you. If you go to the notes, you can find that. Wouldn't that be cool? So if they look funny, you can go read about why it's what it is, huh? So what's 1204 divided by 3653?
32.87.
What's the second one? Somebody want to do that one? Did you do the third one? She's doing the second one. Do the third one. So what did you say the first one was? 32.87. What's the second one?
34.63.
Okay, what's the third one? We got three of them. One way we can do it. But if you go to the notes, it'll tell you what the statutory rate is and then why you're different than that, right? And whether you have state income taxes or whatever, because they're probably paying some state and some federal. What rate did you get on the third? 1741 divided by 5056.
34.
34 and a half. Two or 34 and a half? One with something less than that?
Yeah.
What do you think? 34 and a half. Let's use 34.5. Okay, write that down as your tax rate. Got it? Okay. And then do we need anything else off of this? Well, you look at it and make sure there's nothing down below that would really continue. There's some discontinued operations, right? And it kind of looks like they always have them, but they got rid of a bunch this year, didn't they? Right? They decided to close down. Target has some trouble. Okay? Right? So anyway, a little bit of trouble, not trouble. Okay? They shut down some unprofitable stores. Okay? That's what's going on. Anyway, so I think I'd probably leave that out. Because discontinued, you probably wouldn't expect to continue every year, and they didn't have much of it before, did they? So that's big, but you want to investigate why in real life. Okay, so let's go to the balance sheet then, huh? What do you want off the balance sheet, gang? You want the debt, so we can get our total debt. Do I care about the total assets?
No.
Not really. I'm gonna back into that by doing the market value. Okay? All right, what do we have for total liabilities? You have total current there, and then they have some long-term debt and deferred. Oh, there's non-current, total non-current. Oh, that's nice of them. You can add the two together. Do they do total liabilities down here? No, but we can do it real easy. 11,736 plus 15,671 is our book value of our liabilities, right? At the end,
Is that 11,736?
11,736 it looks like, and 15,671.
27,407.
Write down 27,407 for ending. What's beginning?
Whatever.
12,777 plus 15,545. Add those up and write it down as beginning. How much is that?
28,322.
Fantastic. Add the two together, divide by 2, and you got the average. So you're going to use the ending for your weights, right? And you're going to use the average for your interest rate. Got it? I get the interest rate really easy now. I've got the average and I got the interest on it. Everybody good?
Yeah.
What is the interest rate? It's going to be really low. And I like to calculate it right now while I still have the balance sheet in front of me. Take the interest expense and divide it by that average debt. What's the rate?
3.1.
Do you think they only pay 3.1? That's a risk-free rate. No, but they have a whole bunch of debt that is not interest-bearing. What debt here do they not have to pay interest on?
Accounts payable.
Accounts payable, accrued liabilities. They do have to pay on this current portion of debt, but that's small. Liabilities on discontinued operations probably don't have any interest on that either. Long-term debt and other borrowings, they do have interest on. Deferred income tax, none. This one, probably none. Other non-current liabilities, probably none. So it looks to me like about half of their debt, maybe, is interest-bearing, you think?
Yeah.
11 here, or 13 here, I mean. And yeah, it's about 13, I don't know, maybe some more than that. But that's about half, isn't it? So what's the real interest rate? It's not 3%, it's what? 6.
Yeah.
Sound reasonable? Yes. Could you look at the notes of the financial statement for long-term debt and find out what their average interest rate is? Because they list a whole bunch of the debt, and list all the major categories of debt, and show what the interest rates are? Of course you could, and we would in real life, okay? But here I think I'd just say that's about it, okay? So did you calculate what the interest rate is? 3 point, and write down the interest rate. We got it now, don't we? That's before tax though, isn't it? So we're going to want to take that times what? 1 minus the tax rate. Yeah, we got it, don't we? Okay? So we can calculate that too now, if we want. Are you good? It's getting better? Yeah, okay, all right. So you take playing with it a bit, guys. Values and companies. Okay, what else do we want off of here? Do you think it might be a good idea to get the number of shares?
Yes.
We can look here, and then I would also look on Yahoo Finance or wherever we end up going, right? MS Finance or Yahoo Finance, whichever one, whatever you use. I get them here, and I go get them there too, because there might be a stock split or something in between, or a major buyback of treasury stock or something. So what do we have? Issued and outstanding, that means what? There is no treasury stock, right? Write down the ending, 640, 213,987, okay? 640,000 million shares, okay? 640.2 is probably good enough, but go ahead. Everybody got it? What do we want from the statement of cash flows? Usually you won't have depreciation laid out the way they did it. It's nice of them, right? It's a separate line.
Yeah, and young they don't.
Yeah, so what would you do? You'd look here, wouldn't you? Depreciation amortization is 2129. Is that the number that we got off the income statement?
Yep.
Yeah, good. All right, so sometimes it's not. And then I always use the one from here, because it probably includes some amortization or something. It's buried somewhere. Got it? Okay, so 2129. Do we need anything else from the cash flow statement? No. And like I was saying, if you want, you can go down to the notes, and you can find, which is not a bad idea.
Income tax.
Did I go back?
Go back, yeah. Income
There it is. It's not very long. Oh, that's, you know what that is? That's in their summary of significant accounting policy. No, it's not. Where's the rest of their tax notes? That don't look right. They've got another one somewhere. That's interesting. You always get surprises every time you do these things. Because they have to disclose the tax. Oh. derivatives, leases. What would you like to know?
Income tax.
Oh, here we are. Here's their tax reconciliation. See that? Here's the statutory rate. Here's the state taxes. Here's their international tax savings. And here's other. And you can see this year we had more international tax savings than we have in the past. Maybe it is going to be more like 33%. But there's 44.6 and 34.6 and 34.4. Maybe it is going to go down, but I think I'd stick with these two being the same at this point. Got it? Okay, and then we can also find the long-term debt note. Whoops. I go by that too. I should type in keywords. Why do they let us do a search on this thing? That's 3. Oh, sure they would. Yeah, 3 ought to do it. Let's do long-term debt. Something like that. See if it gives. Still didn't do it, did it?
Because it'll only do it if you search that way, if that's exactly what they got. If they call it something else, it won't give it to you.
Now they got long-term investments. How many did I find? 1 million of them probably.
No, just one match.
Only one match.
Yeah, for long term, yeah.
That's the only time I used to search long.
The liabilities. Yes, you can get
There's
fancier.
56.
How many of them?
56 matches.
Lovely.
Once
Yeah,
you-
liabilities, 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 liabilities. Anyway, yeah, it's easy, guys. Yeah, anyway, usually you have a note called long-term debt. Maybe it's called interest or something. Leases, income taxes, other non-current liabilities. It should have been before that.
There was one up there, I don't know what it was. But
Oh, well. Anyway, if you go to that, they'll show you all the different interest rates. Did you find it? Classification and fair value. Is this the one you were looking at? No, there it is. Outstanding. No, that's swaps. They show you what the interest rates are there. I got a lot of stuff. Oh, here we go. Commercial paper. Is this borrowed? They show your interest rates here. Now, this is investments. Look at those interest rates. Are horrible. That's investment in commercial paper. But if it's millions, so there's the total long-term debt. Well, there it is. Debt maturities in dollars. The note was called notes payable and long-term debt. I don't know why. Well, it would have picked up that long-term, but it would have taken us. No, I didn't have a dash when it did it.
Right.
Okay. Anyway, so here's what their interest rates are. See all that there, you guys? And you can find out. Does 6% sound reasonable? Look at them. Yeah, pretty good, huh? Okay. Anything else we need from the statements? What else we need in the formulas? I think we got it all, don't we?
Yeah.
All right. Okay. So then where should we go?
Yahoo Finance.
Maybe Yahoo Finance? Is that going to search target? Or go away from it?
We'll use whatever your default search is.
Okay, good. Very good. All right. Okay, so business finance maybe? Wanna look at that?
Yeah.
Quotes and info? Look at that. Doesn't matter. What do we need?
What's the target?
Look at target.
Other TTC.
If you know their code, you can type that in. Oh, wait, that didn't do anything. There's Target, Target Corp. Which one is it? This is Frankfurt. What do you bet New York Stock Exchange is the one we want?
Yeah.
Okay, so let's do that one. All right. Was 78.43 the number we had before for the stock price?
No.
Probably changed in the time that we were messing around.
Yeah.
You go ahead and use that. What do you need here?
Beta.
You need beta. Do you see beta?
Yeah.
Yeah, beta's right there. 0.615273. Write that down. What does that mean?
They're not as risky.
Yeah, they're not very risky. They're not, right? Very predictable. Okay. If you look at Walmart, they're like that too. Okay, they're big.
Can you
Business
look at
doesn't
one more
fluctuate.
real quick? I just want to see like
It's lower
the
than
difference
that.
between the beta.
What's that?
It's lower than that. It's like 0.4 or something.
Walmart is? Yeah, that would make sense. They're real stable, real big, right? That means their income doesn't fluctuate very much, right? That's all. Okay. What else did you want to look at? There's the point one. Wow. Okay, all right. So what else do we need, you guys? We need to know the outstanding shares, don't we? Well, here's market cap. When we take the outstanding shares times the market value per share, we're going to get 48.32 billion. It's a big company. Okay, pretty big company. So what would we do then? You need more information to get the outstanding shares, because we're going to need those. So let's go find them. How do you do that? Down here, there is key statistics and more key statistics. Click on more key statistics, and you're in there. Okay? And what this is going to give us, well, are you going to do it? No. Oh, there we go. All right. There's market cap. See it? Okay. There's, let's see. Don't use those financial numbers here, right?
Average volume, 3 months, over here, down.
Yeah, here's beta. You don't need the average volume, though. What you need is outstanding shares. Right? So here's beta. Here's share statistics. Yeah, go on, I see what you mean. How about 616.05 million? What did it say it was on the balance sheet?
640.
600? This is a more recent number. Let's use this. It's close. Yeah, you're just using your judgment here. Okay? So take the 616.05, take that number, million, times the 78.41 per share, and what do you get? I hope you get 48.3 billion. Do you?
Yep.
Okay, that's where we're at. What else do we need? One more piece of information I can think of if we haven't skipped anything. Nothing else here, I don't think, right?
No.
Got the shares outstanding, we got the market price, we got the beta, right? What else do we need? There's not very many things you really need to do this. What else?
Treasury rate.
Treasury rate, you got it. Okay, so I want to know the treasury rate. So where would I find that? They have
Look it up.
prices up here.
Should be like 2.6.
Oh, that wasn't it. Okay.
Can't you just look up treasury rate?
Yeah, but usually they'll give you a whole bunch of different things if you do that. If you go here, maybe it's market data. There it is. Under market data here, you can go and find out what bonds are doing, because we're looking for bonds. Maybe I'll find out what bonds are doing. There it comes. So look at that. U.S. Treasury bonds. Isn't that nice? There's the 30-year, okay? And you want yield. 2.61. It's even less than 3. 2.61, right? That's what it is right now. Write that down. You're going to use it. Now we're ready to calculate. Everybody good? That's too easy, isn't it? No, maybe. So what do we do first?
First,
Let's
we
get my screen back.
try to figure out WAC, so we have to figure out the cost of that.
Yeah. What I want is estimated cash flows. And you know this, right? I'm going for this. Divided by WAC is going to give me what? My estimate of the market value of the assets. So get ourselves organized. Subtract what? Estimated market value of the liability. Equals, we didn't need to write down the income. Oh, we didn't write down the income? Did anybody write down the income? I guess we didn't need to write down the income. Are you still in there? We did. Yeah, we do have to write down the income. Well, whatever we think the income is, but we didn't change anything, did we? So what we need is the income before tax, because we're going to take it times 1 minus the tax rate, right? But what you want is the income less the interest. Remember they separated the interest? Okay, can you find it there? Yes, sir.
When you invest in stock, do you value each company that you invest in?
Oh, no. Only if you're going to make huge investments. I wouldn't do that. No, but I could do it. If I was making a major investment, oh yeah. If you're working for a brokerage firm, though, you do this? Oh, yeah. Investment firms in general? Yeah. Okay. Banks? Yeah. For companies that are buying stock in big chunks? Yes. How about if you're going to take over a small company and use the same kind of a model? You just have to estimate the beta. Oh, so one company's taking over another, you can value and use it. Same. So all kinds of applications. But if I'm buying and selling stocks for my portfolio, probably not. This is gonna be what? Estimated market value of what, guys?
The equity.
Equity. And then what are we gonna do? Divide it by the outstanding shares, right?
Yes.
And that's gonna give me my estimate of the market value per share. This is where we're going. Okay? Nothing to it, huh? So let's just start doing it, right? What was the net income, by the way, or the
Before tax.
the operating income before tax, I guess, is what it would be, right?
3.653 billion.
3.653 billion. Okay, so you want that number too. Now we can work everything. So let's try estimated cash flows. What are you going to do? Operating income, which is that number. How much was it? 3 point. Well, no, it's the number before tax. Well, that wasn't it before tax. What was it?
3.653 billion.
You say two.
3653. Yeah. That's 3,653 million. Okay, that's pretty good. Okay, these are in millions. Okay, so be careful with that, obviously. Times what? 1 minus the tax rate. We got ourselves a tax rate, didn't we?
Yes.
So we'll keep recording this, guys. It's for people that believe. Okay, what's this? 1 minus, what did we say it was?
34.
We decided 34 and a half. Okay, good. Okay, so you multiply those two together, and then what? Add back the depreciation and amortization, right?
Yes.
Study hard, okay? Watch a few videos. I do a bunch of different things. All right, so how much?
Oh. Oh.
Million. Okay, so we can get our estimated cash flows already, can't we?
Yes.
There's nothing to it. So 3653 times 0.655. The hard thing is knowing what you're going to go find and what you want to use, and of course, doing it in real life. Think a lot about what numbers you use, right, and why. So 3653 times 0.655, is it? And then add that to 2,129. 2,129.
4,521.7 million.
22 million. You like it? It's good enough. Because these were even millions anyway, right? So I probably make that good as good million. Doesn't have to. Do whatever you want, right? 4522. Sound good? I have this number already, right? We're on our way. Let's do whack.
And WACC equals the cost of the equity times the weight of the equity. Plus
Okay. And you can put the debt first or the equity first. Who cares?
the cost of the debt. Plus the weight of the debt. Oh.
So I need my weights, don't I? Let's do my weights. Okay? Sound good? What was the ending liabilities? Because we're using that as a proxy, right? For liabilities.
27,407.
Dad took a little longer to do this than I do, didn't he? Yeah. Get scrambled a little more in here. Okay. What about the equity? How many outstanding shares was it? 0.40. Okay. What's the market value per share? What was it? 78.41 per share. And that's going to be the market cap, so we can make sure we got it right, huh? Okay, how much was that? $616.48 times 71.41.
48 billion.
48, comma, the 646, let's keep it constant across. Sound good? Is that what what market cap was? It is, isn't it? Yeah, so we're fine. Okay, add those two together and what do we get for total assets? So obviously you can just use market cap, but you need the outstanding shares too, right? Add those two together and you get 75 something, 76.
76.53.
76, 053.
Yep.
Looks like it to me too. 100% of itself, divide the 76,053 into each of them, you've got your weights, don't you? What are they? Carry those out, maybe a decimal place or something.
Looks like 30%
Yeah.
that's about right, 32.
36 point,
Okay.
see, 0.05. So let's just use 36 then, huh? Right, pretty close. And then the other one, 64. Oh, I calculated to make sure I didn't screw up the math. Because there's so few calculations in this, really. There really aren't very many, right? So once you realize what you're doing. So what do I got? I got my weight. My weight and my equity, I said, is 64%. My weight of my debt is 36%. I usually put debt first and then equity. I don't know. That's the order of the balance sheet. I said it that way, so I did it. I don't care. All right, then what do we need? Cost of equity, maybe? What's the cost of equity? Cap M, right? All right, what do we want to do? What's that going to be? Risk-free plus what? Beta times the risk premium, which is risk-free minus, which is just in the market, return on the market minus risk-free. Okay. Return on the market minus risk-free. Okay? So what's risk-free? We went and looked it up, didn't we? No, that's our interest rate. We looked at the 30-year Treasury bond rate. 2.6 something?
2.61.
Okay, this is 2.6. Let's just use 2.6. That makes sense? What's their beta? 0.615 maybe. Okay, good enough. Return on the market minus 2.6, right? Risk-free is 2.6, it's 2.6, but it's there, it is there, right? Okay, what do you think the return on the market should be? Well, what do you think the risk premium ought to be? Maybe you can do it that way. What's a normal risk premium? We said in the paper 5 to 7. I lost on that. I think it's 5 to 8. I think it varies more than that. Okay, but there were two of them, one of me. I saw fine. You guys be wrong. It's all right. Okay. That's based on my personal experience. It's kind of 8% over my investing for it, right? But okay, 5 to 7. More conservative anyway. Okay, so what would that be? What number do you want to use? 6? Somewhere between 5 and 7? I don't care, right? I'll give you one. If I tell you the risk premium, that's the risk premium. If I tell you the return on the market, that's the return on the market. What would the return on the market be if the risk premium is 6%? What are you expecting the market to do for us? We're all the way down to 2.6 on the risk-free rate, right? Treasury bond rate. Add 6 to it, you got 8.6. Do you believe that the market is going to earn 8.6% next year? Yeah, probably. Do you believe that as the risk-free goes up, that return on the market will go up? Yeah. I think that's a reasonable estimate. Okay? Good? Good. Depends on how optimistic you are about the future, basically. So let's calculate it. 0.615 times 6% then, huh? Plus 2.6. What do you get for your cap hit? It's going to be pretty low, huh? 4.18. 4.18. Why is theirs so low?
They don't have a lot of fluctuations.
They don't have much fluctuations. They're not very risky at all, right? Risk-free would be 2.6. They're more than risk-free, but not an awful lot, right? Okay. So 4.2, does that sound right? 6% times 0.6
I got 2.64.
is 2.6. 2.6 plus 2.6, it's around 5.2. What's 60% of 8%? Or 6%? 3.6. I'm sorry, I did one. So 60% of this would be 3.6, and then you add that to 2.6. That's about 4.2. Okay. Did you get it again? You get 4.2? You do too? I guess it's right. 0.6 times 6% just seems really low. 6 times 6 is 36, right? Plus 42. Or plus 26, rather. 36 and 26 is 4. I can't do it. 36 and 26 is more than 4.2. That's wrong. Why did you say something? Didn't calculate it, did you? Can't do it in your head any better than I can. This is 3.6 plus 2.6 is 6.2. You guys get what you calculated? Right around there. 6.2 to 6.3 maybe. Somebody do that. You see what we're doing?
What's 3.6?
0.615 times 6% is about 3.6, a little more than that, right? What you're doing is you're taking 8.6 less 2.6, which gives you the 6, okay? So we're guessing the 6% risk premium, okay? So that times 0.615 gave you around 3.6, right? Then you add that to 2.6, and what do you have?
That's
6.3%. Okay, there we go. Can't believe you when that's going on 4.2. I thought it was wrong. It's got to be wrong. Okay, anyway, that's 6. Anyway, all right. So what do we do with that one? That's KD, isn't it? Or KE, rather. 6.3%. So you can multiply those two together, right? Take 64% of it. That number means nothing, right, guys? It's just a weight times an interest rate, right? A return rate. So take 6.3 times 0.64 is the way I like to do it. Convert one to a decimal and leave the other one at a percentage, and you'll be more likely to get the decimal in the right place. Because these can be really strange looking numbers sometimes. What's the debt's going to be? What's 6.3 times 0.64? 64% of 6.3. It's around 4, huh? Throws you here. I'm glad you're working on it. Not learning much, working on it. It's interesting stuff gets tough, huh? It's more fun. 6.3 times 0.64. What is the number? Come on.
4.032.
Okay, I hereby decree it's only 4.0. Okay, I don't care. All right, you can use 4 point. Maybe we should use 4 point. No, it's 0.3. Okay, we could go further if you want. You can leave decimal points if you want. Okay. What's this one going to be? KD. Let's do KD, everybody. We already did this, didn't we? It's the interest divided by the average debt. This is a good way to do it for a company that already exists, right? And that's going to be what? My interest rate? But that's before tax. So what do I do? 1 minus the tax rate. You got it. So what would we do here then? What was my interest? It was 3.1 is the interest rate. What we did was we took the interest and divided it by the average earlier. Remember that? Or that was after, wasn't it? That's KD. That was after. Before tax was 6%. And then you took away 1 minus the tax rate. You got around 3. Or it was 4 and 3 or something. Is that right? Is that after tax? So we got 3.1. Sound good? Times 0.3. Yeah, this is going to be all 1%. 1.6, is that what it is?
No.
Does everybody agree that it's 3.1? Can you do that again? It was the interest expense divided by the average debt, right? Was around 4% or something? Times 1 minus the tax rate. Is that right? Double check us. You better do it. You guys seem indecisive. Again, what's the interest? Let's do this. What's the interest? What's the interest expense we have? How much? 882. What was the average debt? Beginning debt plus ending debt. Divided by 2. What was that? We wrote both those down. Okay, here, didn't we?
27,864.5.
All right. Are we good? I'm going to delete by real soon. over at U of L and I gotta walk over to my car. And I have to park at U of L. I went there yesterday, the parking garage was full. God, much less go to school there. Next to the School of Business. And I asked the woman, where should I go park? She said, I have no idea. This is full, everything's full.
Yeah.
And then I said, I'm meeting with an assistant dean. She said, oh, okay. And she gave me a ticket. A few people were leaving. Just go hunt for a spot. We'll probably find 100 people start to leave. So that was 27,864. Otherwise, if you're a student, I guess you just go home. That's great. Right to bicycle to school. What was this percent? That's before tax.
3.1.
It was 3.1. And then we take that, oh, that's before. And then we said only half the debt was interest bearing, right? So it was around 6% was their normal. That's why I hung up with you guys. 1 minus the tax rate we said was 34.5. Okay, there we go, right? 0.345, okay? So 0.655 times 3.1, that's the after tax, right? That's KD. How much is that? Try to mess me up. 2%?
Yeah,
Even?
yeah, it's 2.03.
Good. All right, so there we go. So be careful, you guys. So this one is not 3, it's 2. That'll be a little better. Okay. You got to think and work carefully, I guess, both. So what's 2% times 36%? So these numbers look kind of funny after a while. 0.7%. So I think whack is 4.7%. What do you guys think? Now I've got whack. Now what do you want to do? Divide whack into the estimated cash flows, right? So we're back up to the top again. 4.7%, and this is going to be my no growth estimate of value. Okay? Sound good? So take 0.047 and divide it into 4522, and what do you have? Hustle, guys. Got a couple more things to do. What's that?
4522.
4522 divided by 0.047. That was our estimated cash flows we had down here, right? Now we're dividing it by the whack we have down here.
96,212.
It's 96,212,000,000. Everybody agree to that? What were my liabilities? We did those for our weights, right? Don't use the average, use the ending, right? That's the ending, isn't it? True? When we did the interest, we did the average, at least I hope we did, okay? When we did the interest down here, we used the average, 27,864. But here we're going to use the ending, 27,407. This time it wouldn't make any difference, but if debt changes a lot, right? It'd make a difference. 27,407. Everybody good? So 96,212 less 27,407 must be my estimated market value of the equity, right? How much is that?
68,805.
58,805.
68.
68,805. Fantastic. And then how many shares did we have?
615.
Yeah, 616.48. What does that give me for a market value per share?
111.
$111 per share. What's it selling for? 78. What does the market think? I think they got problems. They're closing stores. I think they got overextended maybe. Right? Didn't they have some problems? Their credit cards got hacked. Right? Credit card information. Right? All their customers. So, they've got to have some things go negative. Right? So, yeah. And competitors coming on. Right? And people moving away from big box stores. It's just reality. Right? I would never go to a Target as long as I don't have to. I certainly wouldn't go to a Walmart. I haven't been to a Walmart in many, many years. I don't want to go in there and buy the junk they've got. I want good stuff, right? I have money, not a lot, but I have enough money to good store. Okay, so anyway, but obviously it's still a big customer base for both of these places. So what would we say the growth is then? Let's do that. How would we do the growth? What must they think the growth is? What do you think, guys? It only takes a second. What do we do? What did I do? That's the one we just did, isn't it? Yeah. Okay, so how would we do this? It's going to be estimated cash flows divided by WACC minus the growth equals what? We already know what the market thinks the assets are worth. What is it? 76,053. This is the estimated market value of the assets, but we know what the market's estimate is. We calculated it to get our weights. So this is fast. 76,053, and right, guys? Because that would give us the $78 a share times 6.16 shares plus the liabilities. True? Okay. So all you've got to do is put your estimated cash flows in. What did we say those were? 4,522. These are all millions. So billions and point. Yeah. Okay. What was our WACC? 4.7%. And you know what's going to happen here is they think it's negative growth. It's going to be a minus growth rate. Right? That's it. Minus. It's going to have to be. You'll see in just a second. Okay, it's going to be a negative growth rate is all I'm saying. Right? So it's minus growth, but the growth rate is going to be negative. Everybody see what I mean? Understand what I mean? So it's still minus growth. Okay? So let's solve for minus growth. Okay? What's it got to be? Take 4,522 divided by 76,053, and what do we get? A bigger number than 4.7, right? So the market either thinks the cash flows are going down by the market by the market by the assets of the shareholders, right? Their estimate, the shareholders' estimate of market value of the assets is 76 billion. Assuming they agree with us that the cash flows are going to be 4.522 billion, right, into the future, what must WACC minus growth be? 5.9%. What does that make growth? Growth has to equal a negative 1.2%. I think hard times are still coming. Now, it doesn't have to be a negative 1.2 forever. It could be bad for a few years and then get good again, right? But over time, it's got to be 1.2, they think. Either that or Target's a real good buy. I think it's a good buy. I don't think Target's going on. And markets are not real rational. Okay? And people invest for the short term, which makes absolutely no sense. So, right? Oh, well, I'm going to sell it really fast after something happens. Go down or up. If you want to do that, buy options. Gamble. That way it goes. Okay, let's do one more thing. How about if we thought really it's going to grow at 1%? Let's do that. What if we thought it was going to grow at 1%? This is it. Look at it. Estimated cash flows, 4,522 times what, guys? Take them times 1 plus the growth rate. So this is going to give us 1% growth, okay? This one up here was the market's estimate of growth, okay? Negative 1.2. What if we think it's positive 1%? What would we do? We would take those cash flows times 1.01, get that number, and we would divide it by what? WACC minus the growth, which is 1%, wouldn't we? You guys with me? WACC minus growth. And what do we think the WACC is? Still 4.7. So I'd have 4.7% minus 1% would be what? 3.7%? So we now think the stock's worth quite a bit. What's 4,522 times 1.01?
4,567.
Take 4,567 and divide it by 3.7, and what do you get? The estimated market value of the assets, right? How much is that? It's a bigger number, right?
123.
123 billion?
3.
Okay. 0.8.
123, 438.
Okay, 0.5. Okay, that's billions. Okay. No, I'm in billions now. 123. Like what?
438.
Yeah, let's use 4.3. Yeah, that's fine. Close enough. Huh? Let's use 4.3. Because we were doing billions before. Let's stay millions. Let's subtract the estimated market value of the liabilities, which is really easy to get, isn't it? Seeing as we used it for the weights. We already used it when we were calculating. How much was the liabilities? 407. Okay, what do we think the estimated market value of the equity is? $123,438 less $27,407. What do you think it would be now? 96,031. And now this is a really good bargain, right? What it's selling for. Divide that by the number of outstanding shares. We had 61648.
156.
So now I think the stock sells for $156 a share. So if I think it's going to go up to 156 and it's selling for 78, what do you think I do? Maybe buy, or at least place a bet on it going up, right? Got the idea, guys? That's it. Big deal. Do a few companies. Right? And go back and work that problem again. Right? It'll be easy now. Right? I didn't mean to spend any time on that. I meant to spend all the time on this, but that's not. Okay. Let's go. Easy? Were you close? Did you get a value?
I had trouble getting my screen because of so much screen games.
You didn't. Oh, she didn't finish it all the way through? Yeah. Yeah, you just. Out of the world. Right? What do you think? It's kind of fun, huh?
Have a good spring break.
You too. Have fun, you guys.